back of every page, whether or not there's any financial data on there relevant to the account balance or not. They need front and back, so that takes additional time to make him understand that every single page. Then the statements that you want written, exactly what they have to cover. That is not always communicated clearly to the borrower. So when they're trying to write these statements, they're giving you or the underwriter what they need to make the decision. So, you're working Monday through Friday, 8 to 5 or whatever. And by the time all of that gets to going backwards and forwards and you're trying to get an understanding all the way around, then you've got 60, 90, 120 days.
And maybe then some on top of that, yeah. So in regards to that, if you're missing one piece of paper, so basically with bank statements, if it's numbered, we need to see it, right? So that's the rule of thumb. And I apologize if that's not normally communicated, but like when you come into our office, because when we submit stuff to our underwriters, it's a complete package. So we're in constant communication with the borrower and giving them feedback on what we need to do to push their file through.
Well, usually you say like all pages, and most people are paying the fax and paying the copy, and they don't want to make any pay for additional copies that are not needed or pay for the additional faxes, and that just little things like that.
It's frustrating.
And then they get very frustrated and discouraged. I spend most of my time encouraging people,
and
give them what they need.
So with that, you can go into any Chase branch, and if the borrower identifies themselves, and then obviously they're gonna check their IDs and stuff to make sure, and then they will fax information in to our 800 numbers. But I will say that there's nothing we do phone interviews with people that we have a lot of borrowers that come down from Reading to Sacramento. We've had borrowers come from Oregon come to my office, and to save them a trip, there's nothing that we can't do. Like my advisors do phone appointments, so as long as they call the center and you have access to email or a fax machine, there's nothing that we can't do over the phone that we can do in the office. In the office that we can't do over the phone. Excuse me. So I guess the whole point of it is for me to come out and get the word out, and in turn, hopefully, you folks will. That there is. We're expanding. Just in Sacramento, I'm hiring another 6. I just hired another 6 people to get, because we are the main Northern California, outside of the Bay Area. So, but I'm saying that they can go to any center, and like I said, the whole point of it is for you to be able to talk to somebody, and they will clearly explain to you and your borrower, And if you guys are representing a borrower, we do ask that you do sign off, obviously, a third-party authorization form, and then go from there. But did I answer your question? Thank you. Sorry.
Okay, on methods 1 and 2, on option 1, where you talk about repayment plan, bring current in 6 months, for example. So they bring it current in 6 months. Let's say they're able to do that. Then what kind of penalties and fees and so on are tacked on to the loan?
So typically, if you've entered into a repayment plan, all late fees and those charges stop, and they would have calculated all those payments plus the arrearage plus your current payment to bring you current. So that's typically how the repayment plans are done. That's the way it should be done.
Okay, so then they go back to making their normal payment is the idea.
Correct. So
1 and 2.
after the 6 months, if you successfully complete the 6 month, and you've some people get into repayment plan and they miss the payment, and that's what we call a plan break. And basically, you're back at square one if you miss the payment on any one of those things. But if you do pay all 6 payments during the repayment plan, you're basically brought current, and we start you from square one.
So if they can't afford the payment they're making right now, or they get behind, how do you structure those 6 months? Is it more than they normally pay, or
well, it's going to be more than they normally pay, because the thing is, like, some people they were unemployed, or they're self-employed and the business was bad and they fell behind. So we look at what they're making currently, and if they can afford. Some people are so far behind they can't afford a repayment plan. The biggest arrearage I've seen is maybe $250,000. We've had people that have made payments in 2-3 years. And then to enter into a repayment plan, something like that doesn't make sense. So then we move on and we see if we can get them for the loan mod.
Okay, and so for method number 2, requiring the payment for 3 months, you know, they don't have to make the payment for 3 months and then they start paying again, is that what it is?
That was just an example of like a type of forbearance plan. So there's people that, like, say for an unemployed borrower that, you know, say they just lost their job, and there is a specific unemployment, you know, forbearance program that we have. Or so depending on the situation, you know, I mean, it could be like, say they're collecting unemployment, we may make it like $200-300, but whatever it may be. I mean, every situation is different.
So they would add the amount that's missed onto the principal of the loan for later, is that what they do?
So any payment that's made will get applied to the principal, but typically, you know, it would go into what we call a suspense account. I mean, I don't mean to get all the nitty gritty, but
Well, I don't want the nitty gritty, I'm just trying to find out what happens to the amount that they can't pay during that forbearance period.
the amount that they can't pay, so the arrearages still accrue, typically.
Okay, so the principal still stays on there but any fees or late fees are ignored?
Yes.
Are waived.
Typically, they're supposed to be waived.
Okay, then on method number 3, you say the loan modification to qualify for 31% ratio, PITI ratio?
That's the HAMP guideline.
Okay, so you, in order to do that, you lower their payments, do you extend the length of the loan, or do you lower the amount of principal? What happens there?
So, and I'm giving you what I see, and I've seen thousands of loan mods come through.
Just a typical example.
So the typical example is interest rate reduction. And it could be, they could extend it out to a 30 or 40 year, depending on the person's situation.
At a lower payment.
To lower the payment, yes. So your typical HAMP, I'll give you an example of a typical HAMP.
Have you seen any principal reductions whatsoever? Yes.
I have, to be honest.
You have.
But, you know, that right now, the principal the principal forgiveness or the reduction, it's not really on the table right now. And if you've heard anyone from any bank talk, you don't want principal reduction. If we open the floodgates on a principal reduction, why would somebody pay their mortgage?
Foreclosure is a principal reduction.
It is, but that was on the borrower's terms. I mean, to be honest, I mean, the borrower still signed the contract to pay their note. 90% of borrowers pay their note, you know, so, yes.
Okay, also, where does short refi fall in all of this?
So,
Short refi.
this gentleman asked about short refis. To be honest, I haven't seen any of those come through my office. You're gonna have to find a lender to basically, you have a lender to actually do the refi, but to have your bank write down some of the, to do the write down. That's kind of hard to do. Yeah. Yes, sir.
On a refi, what percentage will they do on the value? Will they do 125% the same bank, or how does that work?
So this gentleman asked about for refi. So for the most part, we try to get refi out of people's vocabulary when they walk in, unless of course there is a program called the HARP, and I don't know if at Chase we're doing quite a bit of those. And what that does is they go up to 125% of the appraised value of the property. Not a lot of houses obviously fall into that 125 because most people are way above that. And typically with the HARP, and again, I'm not a loan officer, but I'm just going over like the program. You know, you have to be current, and those loans, that program is available. And if you talk to any loan officer from Chase, I know we do a lot of those loans. I don't know if I saw something from Wells Fargo. I don't know if they do a lot of those. So. But it is a program, and it is part of the Making Home Affordable. And from what I hear, they extended it out to 2013 for the HARP, the Home Affordable Refinance Program, for anyone that's interested. Yes?
How do you figure the 31% ratio? And the reason I ask is because my sister applied for the loan modification when she got a divorce.
Okay.
She was already working 3 jobs. They told her she needed $200 a month more income to qualify, so she went out and got a 4th job, got the $200. She did get the loan modification. Her payment went from $1,700 to $900. But why did they make her go get $200 a month more income? I thought it was based on what your income was, and then they work backwards. That must not be the case.
So for the home affordable program, you basically have to fit into the box. You can either make too much or too little for a loan mod program. If your income is below 31%, you can afford your loan. I mean, if your PITI is at 31% of your gross income, you can afford your house. But if
Hers
it's,
was like 80%.
it was 800, okay. So
Yeah,
the
her-
goal
her
of it was to
total
bring it
income was
from,
going to the payment.
or you can make too little. So for instance, we can't just modify your loan and you have no money to live and pay your other expenses. You have to be able to live and afford your house. So to qualify, so in that circumstance, she probably made too little and to fall into the box. Basically, she needed that extra $200. And it's kind of crazy, but it dropped so far. But there's a lot of different variables that are involved in that. I mean, like there's property tax, and that everyone here knows that fluctuates, and everyone and their brother and sisters filing, what do you call those things with the county? Sorry, those things, real professional.
Assessment.
Yeah, the assessment, the rebuttal, the reassessment, thank you. So there are a lot of different variables, but the whole gist of the Making Home Affordable, like I said, and we look at your gross and basically your front-end income, your front-end ratio. So.
What's the DTI on your CHAMP program? Is it different?
It's classified. No, to be honest with you, I don't know. I can't speak because when you're looking at a loan mod, it is investor specific. So
What's
Fannie and
the
I'm sorry?
What's the guideline call for?
Well, so for the CHAMP, most CHAMP stuff are run, or CHAMP mods are run under like whoever their private investor is, because the HAMP, Making Home Affordable, was generally designed for Fannie and Freddie loans, which is more than half the loans in the country, right? And then FHA. But FHA actually has their own mods. So so for instance, Chase, we service about roughly 9 million loans. And of those 9 million, more than half of them are Fannie Freddie loans, and then the rest fall into whatever investor bucket owned the loan. So it is specific, and for me to talk to it would be, to be honest with you, I don't know. But we do, so that's why I'm saying that they review everybody for the different loan programs when it comes through. But we do try to push everyone to HAMP if it's going loan, if we see that it can go loan mod. So, any other?
Are you specifically doing the hiring for these centers, and if so, what are the qualifications for that person to be hired? Because we're finding that some of them don't seem to have a lot of knowledge in loans. I mean, you're able to quote ratios and program guidelines and such, but what do you look for in that?
So she's asking what are the qualifications for people that we hire? So it's a good question. So anyone that I hire needs 3+ years of mortgage experience. They basically need, because when you're qualifying people, like when you're an advisor, you're kind of a counselor, even though.
We have to be licensed, I'm
Yeah,
curious. as to
so
that.
you have to have a mortgage background and be able to understand qualifying ratios and be able to deal with very, emotional, passionate people. Because let's face it, we're talking about somebody's home, and we know that, and we also have no misconception of what's going on in the economy. I mean, from what I see, this is gonna get worse before it gets better. And if you look at the default rates across the mortgage industry, they kind of go hand in hand with the unemployment rate. What's the default rate right now? Roughly 10%. What's the unemployment rate? 10%. And we don't, from the indicators that we see, I don't mean to put a rain on everyone's parade, but we're expanding our loss mid efforts. So I would say the short sale in the area is basically going to become more prevalent over